bankruptcy costs. Okay, if the company did not take any precaution or identifying their risk, mitigating their risk, okay, what will happen to the company is they go for bankruptcy. So bankruptcy means that the company is no longer able to sustain, to continue with their businesses. So what they're going to do is that they're going to liquidate the company and file for bankruptcy. Okay, so when we talk about this bankruptcy, there will be direct and indirect costs that associate with this scenario. For example, you have to pay the compensation, you have to pay a few other obligation, fixed liabilities, long-term liabilities, um, um, current liabilities that you have to uh, pay everything. You have to settle everything. So this is what they call as direct and indirect cost of bankruptcy. When it comes to human workers, employees, there also be compensation. Okay, so it will create um, more what call it cost to the company. That is basically the direct, the indirect cost that associate with bankruptcy is, let's say that the company is already listed in the public in stock exchange. Okay, investors who bought their shares, they're also been affected, meaning to say that since most the one that have been traded in stock market is the one that we call common stocks and common shareholders. So common shareholders or common stockholders, the last person will receive any money if the company is still able to have certain amount of money to be dispersed among the share. But normally, what happen is that the shareholders won't get anything. Okay, that means the company will be delisted, and when they delisted, that means they have to pay everything. And then the company will not able to pay back their capital. Okay, so that why is it so important? It is very important. Okay, once a company is closed down, uh, yeah, for the business itself is a closure. Okay, fine. Okay, and then the investors also, those common stockholders, they won't get anything. And if you look at the bigger scale, wide wide view, we can say that closing companies, bankrupt companies, may have a direct impact to the country's economy. Okay. So when you imagine those who are working with that companies, now they are jobless, and when it comes jobless, then the numbers of unemployment rate will increase, and then it will affect definitely affect to the condition of the state or the government at that particular place. And then we have, why is it so important is we have another thing is what we call as tax. Okay, risk management can reduce the cost of company and reducing the volatility of earning. And so by identifying all these things, tax, we can reduce the tax. Okay, but if we did not identify any risk associate with the operation of the business, tax might can influence, not to say influence, but then can affect the operational, the financial structure of the company. Okay, tax will we have to pay more tax if they don't have a proper plan, financial risk analysis plan. Then it will automatically affect the company, but by paying more tax compared to other businesses. The third one is the capital structure and cost of capital. Okay, is the inability to control cost of doing business. So if you, for example, if you don't have any plan, risk assessment, and something happened, let's say your something got to do with your workers, and then you might get sued. So this is the types of risk that can happen to the company if they don't have a proper mitigation plan. Capital structure also the same thing. The cost of borrowing money. If you are taking up more loans, that means you have a fixed liability, which is the interest rate that you have to pay. If anything happen, that means uh, your your company may sustain a much bigger loss because of you have to pay, and at the same time your operation is not as good as what it was supposed to be. Cost of capital is the cost of capital. I mean, you're borrowing money, so this is something that to do with the interest and the capital structure of the company. So capital structure, basically, normally the company will try to minimize this. Okay, what company will normally do is that they will try to balance out between debt and equity. So that's the reason why they sell their shares in their stocks, so that this become an equity. So and then the cost of capital of this stocks and common stocks is basically at the discretion of the board of directors, the company itself. So that means if the company may have um, less income, net income, or smaller net income, so the dividend for the common stockholder will be a bit small, compared to if they have they're making a big net income. But what we're trying to say here is that the company will decide, the board of directors will decide how much they want to pay. But um this debt, which is the cost of capital will be interest rate, whether your company is making a good money or not, or if the company is having a bad shape in terms of financial structure, you still have to pay. So that's the reason why a lot of company, they try to balance this thing out. Okay, this is what they call as capital structure between debt and also equity. So equity is much more better a little bit compared to debt, because of, like I said, equity is the cost of capital of equity is basically the dividend. Okay, so we have to pay dividend to the common stockholders. So but the amount of dividend that we are going to pay, it depends on the board of directors, depends on the performance of the company. And okay, so if like I said, if the company is making a lot of money, then the dividend will be much bigger compared to if they have very small net income. So the dividend also will become, even to that extent, to some extent, um, um, the company may uh, announce that there'll be no dividend for that year. Okay, so the common stockholder, they cannot do anything. Okay, because it's all at the discretion of the board of directors. But when it comes to that, whether you like it or not, you have to pay. And then why is it so important? Because of the compensation packages. Okay, you see, the riskier the business is, the higher the compensation on standby. Meaning to say, if let's say you're investing in oil rig, for example, okay, oil and gas industry, so the risk is very high. So when his risk is very high, the compensation also will be very very high. So if anything happen, you have to you're liable for it. Okay. Um, so we have these sources of financial sources of financial risk. So financial risk arising from an organization exposure to changes in market price, such as interest rate, exchange rate, and commodity prices. This is basically from what we call as market risk. Something that we call it as market risk, where basically this risk is um, difficult to diversify, and sometimes they call it as systematic risk. Systematic risk means that nobody can do anything about it. For example, interest rate. If interest rate increase, okay, some companies, some corporate will be affected, some may not. So but everybody will be affected there's no one can control this exchange rate, commodity prices, and you see the corn, the cocoa, the gold. Okay, this commodities is fluctuate. It's all fluctuate, so nobody can basically um, do anything about it. Okay, it's a free hand. Okay, so so that is something that that's why we have economists. Okay, we try to predict. Okay, if the interest rate increase, what happened to the price of bond, for example? If interest rate increase, the normal interest rate increase, the market interest rate increase, the price of bond will go down. Okay, because of people will tend to go for getting revenue, getting income from interest, the increase in interest rate compared to buying a bond. But if let's say the interest rate is going down, what will happen to the price of bond? Bond will increase. If let's say the central bank declare that the interest rate, they were going to lower down the interest rate, what will happen? What happened to the business? So this is the what we call as market risk. If the interest rate go down, if the central bank declare they will lower down the interest rate, so basically business will be booming. Okay, because the cost of borrowing money is very cheap. Okay, but at the same time, the cost of the price of bond, because of the interest rate decrease, uh, the price of bond have to be decreased as well, because of the tendency for people to buy bond will not be there. Okay, and then we have another source of financial risk rising from the action and transaction with other organization. Okay, such as vendor, customers, counterparties in derivative transaction. So this is something got to do with this is more on the first one. The first part is basically more on the economic side. Okay, that's why we call it market risk. But this one is more on the operational risk, credit risk. It is between the business transaction, business world. Yeah, the transaction between one organization to another organization. One company closed down, what will happen? For example, if bank closed down, the next bank next will also be in trouble, even though there's no link. Basically, they have their own businesses, but still, this is what we call a systemic effect. They have one if one of any bank collapse, and so the tendency for other banks in that country may also be affected. And the worst case is that every bank will collapse. And when that collapse, and all the banks collapse, that means the economy will collapse, because everybody put their money there and our money is not being insured. So companies, they are very afraid of this. So that's the reason why the government, they have a very strict regulation when it comes to any transaction between banks and companies. And they want to make sure that the economy will financially stable. Okay, so customers and counterparties in derivative transaction means that if there is a futures and forward, you're betting on something which is in the future. This is very risky. Okay, so in the derivative market, for example, where they traded all these commodities, in Malaysia we have cloth and Kuala Lumpur option futures and forward exchange. We have Chicago Board Trading CBT in Chicago in US. um, uh, we have few markets in world which deals with derivative. So derivative is basically something that you are basically entering into a transaction, entering into a business, but this product will be realized, or whatever commodity that you are trading in will be realized in the future. That's why they call it as future and forward. So when we talk about futures, we don't know exactly what is happening. We cannot predict. We can predict, but then we don't know what will happen. Okay, so there are few I can say steps or means and ways for you to do trading in derivatives. That's why derivatives is not so popular, because of the risk is very high. Okay, and not only about the commodity, then you have to take into consideration all other aspect 360. Okay, for example, if you are trading cocoa, for example, you need to be alert when it comes to the weather in that particular area. Okay, if it's going to be raining next week or 2 weeks after this, then the quality of that cocoa will drop down. So when the quality is going down, the price also will be go down. So these are the things that you need to predict, you need to identify. In financial risk management, when it comes to derivative transaction, derivative market, you need to identify all this. If there's a, for example, a trade war between US and US and China, for example, it also affect commodities market in Malaysia, because of basically we are maybe producing cocoa to supply to Cadbury chocolate company or Hershey chocolate company. So if this thing happen, it will affect our transaction in local economy. Okay. And then last one is another one is the financial risk resulting from the internal action or failure of the organization. Okay. So this one is more minute, more micro. Okay, we're looking at the company itself. Okay, the way that they manage the business. Okay, so on top we have macro. Second one is more on the business landscape, and the last one will be on the micro aspect of the business. So we're talking about human. Human makes mistake. Sometimes when we predict, our instinct is not as good as animal, for example. Okay, so we cannot predict. We try to do our level best, but anything can happen. So, or maybe a mismanagement in terms of money, and this is what happened to 1MDB, for example. Okay, the case of 1MDB is a human. It's not because of the economy, but it's not because of the business, but it's more on the human error, human mismanagement, human fraud that leads to this, you know, turn of a century financial scandal in the world. So we, for Malaysian, you should be very proud because of this, we are very popular when it comes to mismanagement, fraud, and everything, money laundering and things like that. Okay, I hope you guys are happy with that. And then, okay, so the meaning of financial risk management. What does it mean by financial risk management? Okay, so financial risk management is basically how you manage the risk. Okay, manage risk in the sense that we try to mitigate, we try to shift, we try to minimize, if possible, we try to avoid and all. Okay, so this is a process. Okay, it's a process in whatever you do, in whatever business, in whatever industry that you are in. Basically, there will be what we call as risk management. Okay, but here we are basically specifically looking at the financial. So we need to identify what kind of risk that we are talking about. Okay, what we're going to face. Those are the things that we have to make sure that we understand. Okay, we have to identify first. As normally people will say that, how can we identify? But basically, it's through our operation, daily activities. Then we can understand what is basically things that we have to have a look. Then then only we can rectify, then only we can prepare ourselves. Okay, if we don't know what is the risk that we are going to face, then it will be a lot of trouble, because of especially in finance, we our money don't have any guarantee, we don't have any warranty, we don't have any experience for that matter. Okay, so the financial risk management is actually a process that identify loss exposure. Okay, possible faced by the company or organization. So we have to select the most appropriate techniques. We have to identify first, and then we have to think how to overcome. If we can overcome, if we can abolish it, it's good. If not, we need to get some ideas on how to minimize the risk exposure. If not, try to mitigate. Try to shave doing the mitigation. And these are the things that what financial risk management is all about. The loss exposure. Okay, what is loss exposure? Is is any possibility of financial loss due to loss of use, damage, financial claims against the businesses. So this is what we call the terms loss exposure is the one that we're going to use. Okay, it means that it's not a good thing. Okay, so it can be um is a loss, right? So that means you have to avoid this, right? So we need to identify this thing first. Okay, and then so the objective, okay, of financial risk management. Financial risk management has objective before and after loss occurs. Pre-loss objective, basically, by having a financial risk management, okay, we can prepare for potential loss in the most economical way. Okay? Instead of we just, you know, just do our business, at least we preparing ourselves. Okay, the company will prepare themselves um, to absorb the loss, okay, or the risk, but try to make it minimize as possible. Okay, is the most economical way. Okay? So the pre-loss objective. The second is we want to reduce the anxiety. Anxiety not only with the company but also the investors as well as the shareholders and also to the country. Okay, because of big firm like for example, okay, I give you a good example. What happened to um, what happened to uh, Malaysian Airline Malaysian airline system, for example. Okay, Malaysian airline system at one time they have a problems. They have a problems in their financial structure. Okay, they incur a lot of loss. So that is actually an anxiety for the investors as well as the country and also the investors. Okay, so that means when we heard about this thing, people will react. When they react, it will automatically affect the stock market. Okay, because we get to understand. Of course, Malaysian airline system is just only is an airline a business, but there's a lot of other businesses associated with this company. Okay, so if that thing happen, it will relate to the other companies. So this is something which is very beautiful in terms of, in financial world where this is what we call a systemic effect. One company problems they will lead to another company's um, uh, uh, their financial health. If the company close down, the other supporting companies or they will automatically affected. Okay. And then of course, we have to understand, we have to get prepared when it comes to the legal obligation. So when it comes to, people will sue, people will take legal action against us, against the company. So this is something that we need to prepare ourselves to identify before that things happen. Okay. When it's happened already, so it's just a matter of survival of the firm. So we need to survive. Okay, in order for us to continue our operation, we need to survive. We need to come up with new ideas. That's the reason why. Okay, there's another method used by the companies when they have this kind of problems, when they can sense that the problem is just around the corner. What they will do is that they will start um, moving their debt to another entity, which is what they call a special purpose vehicle, SPV. We will get into it later on. Okay, we will discuss about what is SPV. So SPV is basically as an entity that the company will move their debt to this particular this SPV, and then SPV will manage the debt. Okay, manage the debt. How are they going to manage the debt? A very simple explanation is that they will price all the debt, and then they will start selling stocks or shares or equity. Okay, so when people buy that equity, automatically it will service the debt itself. But the company who already gave that the debt to the SPV, they can survive. Okay, they can continue their operation, okay, without thinking about the loss, because of there's an arrangement between this SPV and also the company. And then there's also differences between the SPV created by the company itself or SPV created by someone else in order for them to help. Give a good example. In 1997, 1998, the Asian is been hit by financial crisis. Okay, they call it as Asian financial crisis. Malaysia is also affected. Okay, Indonesia, Singapore, Thailand, Burma. So few other Asian countries are all affected because of this Asian financial crisis. So what Malaysian government did at that time is that what is happening at that time is that most of the bank, okay, the NPL, the non-performing loan, means that it's like a bad debt. Okay, people cannot service their loan because of there's no work, they cannot work. And what is happening in right now during the MCO, during this pandemic, is quite similar to what happened in the Asian financial crisis, but it's not as severe as in 1997, 1998. I mean, people can still, it's not because of it's just because of the pandemic. So people can still work, they can still work from home, they can still, they've been, no, they can still do their business with limited, with, strict SOP and so on and so forth. But during the 1997, 1998, people cannot service their loan because of they lost their job, just like what is happening right now. And then at that time, we don't have any moratorium. Okay, here this time, that's the reason why the Malaysian government gives 6 month moratorium, meaning that you don't need to pay your service. You don't need to service your loan. Okay, you can use that money to survive for another 6 months. Okay, because of so that's one of the tools used by the Malaysian government. But during 1997, that was not the case. There's no moratorium. So what happened is that a lot of them being laid off, companies closed. Even to some extent, there are few banks closed. The first bank closed is the Sime Bank, Sime Derby Bank. They call it Sime Bank. This is the first bank in Malaysia. They have to close down, but so it's really panic at that time. We're talking about reduced anxiety. There's a panic in the market, but luckily Malaysian people at that time, they don't know what is the consequences, the repercussion of a closure of a bank. So people still remain calm. Okay, only those who've been affected. I mean, there's a VSS. So when things get worsened, few banks also, they said that they cannot sustain. So what the central bank did is that under the purview of under the directive from Ministry of Finance, they encourage banks to merge. So this is another what call it method in terms of risk management. They merge. Okay, we're not talking about acquisition. Normally it's merger and acquisition. We are talking about merge. We are merging two banks to become one bank. At least that bank can still there. Okay, we can still retain some workers, and operation is still going on. So that's the reason why last time, I don't know whether you still remember, last time we have Bumi Putra, Bank Bumi Putra, and then we also have Commerce Bank. So they merge together, they become Bumi Putra Commerce. Now they merge again to become CIMB. These are the tactics, strategy used to reduce, minimize the risk of economic collapse. Okay, so during that time, the NPL is shut off. Okay, because of people cannot pay because they don't have work, they don't have job. So what the government did is that they create one SPV. They call it as Dana Harta. Dana Harta is under the purview of Ministry of Finance. So what Dana Harta do is basically buy all this bad debt from banks, because when the debt is still in the account, bank's account, in the financial statement, bank financial statement, so it is not a good thing. Okay, so they still have to pay. They have to, even though, okay, fine, you can just simply write it off and and declare that as a bad debt. Okay. um, as far as accounts is concerned, um, reporting is concerned, it's okay. I mean, you already declared for certain time. Okay, you didn't get that money back, so you consider this as a bad debt. But we're talking about the amount of the debt is still there. Okay, it's been the bank still have to face this. Okay, it's not like you can just simply declare it's a bad debt and then automatically it will be right off and in your financial statement. No, it's not like that. The amount of money is still that huge amount of money is still you didn't get any from the public, from the lenders. So what happened is that they group all this debt, they sell it to this dana harta. So dana harta act as a SPV, okay, at that particular time. So what they did is they work with it's actually under khazanah. So what they did is that they they restructure the debt, okay, and then they turn it into equity. So they encourage people to buy, and when you have all these shares, there'll be some return on it. So public, those who still got money, they can still buy. So basically, they are servicing the debt for the bank. Okay, SPV, the dana harta servicing the bank. So until it's done everything, okay, somehow we managed to get through, and then I think after 5 years or 6 years, if I'm not mistaken, then they close down the dana harta, the SPV. That means they have done their job, okay, trying to mitigate the risk, and instead of being hold by the bank itself. Now they hold that debt, and then they manage the debt by selling equities, and then when people start buying, and then it recover whatever loss incurred by the bank. Okay, so this is the things that we need to do in order to have the which goes to the third point, which is the stability of earning. Okay, so it needs to be stable by using this kind of method. Okay, so just so happen it works. Okay, but what I'm saying is that this SPV, not every time it works. Okay, it depends on the structure itself. A good example later on, okay, you can just go through this. Enron, okay, they create their own SPV, but it doesn't work. Okay, what happened is that Enron, being most biggest company in United States of America, Enron within 1 year, the company shut down. Okay, the company goes for bankruptcy. Even though they have a SPV, but the structure is not itself is not good, and then it there are a few other factors. Okay, there are a few other factors that contribute to this, but basically what I'm trying to say is that they create SPV, but that SPV did not work as well as what dana harta has done. Okay, so so then we need to think about the continuing the growth of the firm. Okay, so how can we for the company, from a perspective company's perspective, so normally what they do is that they will minimize the operation costs, in order for the company to continue their business, and later on then only they it will go. Some Another method that they used during the 1997-1998 financial crisis, in order to making sure that the company still carry on, that they cut down the employee salary. Okay, so that's how let's say for example you get 10,000 ringgit, your salary is 10,000 ringgit, but the company can only pay you 6,000, but at least you have 6,000 rather than you have nothing. So that's the idea behind cutting down the salary. Okay, you still have jobs, and but then everybody is suffering. Okay, but you still have job, but you still have some income, but it's not as much as what you used to. Okay, so that's the method, okay, in terms of mitigating the risk. Okay, yeah, which is same goes to the last point, which is they minimize the effect that loss will have on other person and on society. So that's how they do it. Okay, in 1997 also I can say that at that time, no, not 1997. In Malaysia, I'm using Malaysian economy as our classical example to show how the government mitigate the risk. Okay? It was in 1985. 1985. Did I switch on my camera or not? Oh, I'm sorry. I didn't switch on my camera. In 1985, Malaysia hit by a recession, first recession. Okay, first recession when Tun Mahathir was in the office, and he was the fourth prime minister at that time. He came into the office in 1980 something, 1981, and in 1983, 1984, 1985, nation hit by a recession. Okay, first recession, which is the price of steel. Okay, the world steel price increased drastically, and at that time, okay, we are at the wrong time is at the wrong time actually, where at that particular time Malaysian government is going for from agriculture economy to manufacturing to heavy industry. So when we're talking about heavy industry, there'll be a lot of, we are basically need a lot of steels. Okay, that's when we have this HiCom. We have our first uh, national car. Okay, we have our first national distributor, Edaran Automobile National Ion. Okay, so at that the particular time, the price of steel increased. So because of that, the government at that time sustained loss, external debt of 2.55 billion. Okay, last time is quite big. Okay, 2.55 billion is quite big at that time in 19 something, 1980s, 1985. Okay, I still remember. I'm still schooling at that time. Okay, my mom, my dad give me our pocket money, 40 cent per day, only 40 cent. Okay, but that 40 cent allows me to buy food, proper food, drinks, and also sometimes snack food, and also sometimes toys. Last time in our primary school, they sell toys, and also when after you finish school, outside there's a lot of hawkers. They sell all this kind of toys. You can still have, and you can use that 40 cent to buy a lot of things, and the value is very big. But now 40 cent, you cannot buy anything, right? You can, that's why in financial management we have this time value of money. Okay, the value increase. So we have the Malaysian government have external debt of 2.55 billion. So which means that the government have to think a way to pay this debt. Okay, how are they going to pay? The income is not. I mean, the foreign direct investment. Okay, the domestic direct investment is not as much as what is happening today. So what the government do, what the nation government do is that they implement privatization. Okay, privatization. The basic utility company, utilities. They privatize all the utilities companies. We last time we have Lembaga Elektrik Negara is no, now they privatize to TNB. Okay, telecom, same goes to telecom, water. Okay, so basically what the government did is they release the debt. Okay, they shift the risk to another company. So with they thought that that time they think by doing the privatization, this company will be more efficient, then they can expand. And then in terms of executing the decision, it's much more better compared to the government, because the government, we have a lot of procedures. But when it comes to corporate, they can just get decision from the board of directors or the management of the companies, and then can execute as quickly as possible. So that's how the Malaysian government, that's how we have this privatization. Okay, because of the external debt that we have, the government shift the risk to another company. Okay, all right. So we will go through with this financial risk management process. So basically, there are five of them. There are five process, and in order for us to identify, explain what is the financial risk management. Okay, the first one is to identify the risk. Okay, we need to identify the risk. That is the most important. Whenever you do, when you do a business, you need to identify the risk that may or may not be in your business. Okay, I think, let's say, take one small simple example. Let's say you open up a car wash. Okay, a car wash. You're looking at the environment of this business. What will be the risk? What is the risk of doing the car wash business? First, it might be the shortage of water. Okay, there's a water disruption, a water supply disruption. So if there's no water, there's no car wash. Okay, so this is how you identify. So how can you overcome this problem? So you might want to buy a big barrel. Okay, or maybe you can have one well, natural well, so that you can get the water will be there. So this is the thing that you want to identify. And then what else? What kind of other risks that you might um, expose to? So they have a lot of things. Okay, here, property loss, liability loss, business income loss, human resources, crime loss, failure to comply government rules. So these are a few things that you can identify. Okay, but since we are talking about this car wash, okay, then we have another risk is about the human capital. You might have a shortage of workers. So how are you going to rectify this? And then the supply of the soap, the whatever, the wax and whatever you're going to use for car cleaning. Even to the extent, a very simple thing, the vacuum cleaner. If let's say you have only one, and it's going to be the usage is going to be very heavy. So if anything happen, if let's say that thing blow up, so you need to have another vacuum cleaners. You have to buy 2 or 3 vacuum cleaners. This is, you already identify, and then you try to rectify. You have some spare parts, or maybe some spares of vacuum. The extra spare. If anything happen, you can just simply use. What else? What are the risks? The workers. Maybe you try to engage local and as well as international workers. Okay, maybe you can appoint foreign workers, but at the same time you need to have local people, local workers, so that if anything happen, if let's say these people ran off, okay, you still have local who can still work, who can still continue the business, that kind of thing. So this is and then what else? The environment. What about the weather? When it's raining season, nobody wants to send their cars. So what are you going to do about it? There is also a risk. So you identify all these risks, okay, in order for you to come up with the solution. So but basically that is business. But when it comes to finance, okay, if you lost, mean that you lost. Okay, if let's say you buy stocks, and then the company, I mean the company shut down, or they are losing their money, not making any income whatsoever, you won't get any warranty. What can you do? So basically, okay, what happened? This is a very good example during the 1997, 1998. Okay, the one that I told you just now is happening. Okay, during 1997, because of when investors, normally they're very alert about this thing, because after all, you put your money in this company. So somehow or other you want to safeguard your investment. Okay, if anything happen, at the click of a button, you will try to get back your money, put it somewhere else, keep it safe, that kind of thing. That is normal. As all investors, they are basically, they are risk averse. They try to avoid the risk. So if when they hear that the economy is going for recession, they will try to take out their money from the company. So but what happened is that in 1997, the Malaysian government, even other Asian countries for that matter, did not expect this thing will happen. Just like what we are facing this pandemic. Okay, last time I remember the day when we only have 2 cases of COVID-19. Okay, and we thought that it's just like another types of flu. Okay, just like SARS before this. Okay, but um, but we didn't expect this, so it's actually worse. Okay, it's much more worse. Not only Malaysia but other countries as well. I mean, in the world, okay, they don't expect that the severity of this pandemic is like this. So not many countries is prepared. Okay, prepared for this. Luckily, Malaysia, we have some. We still have some money to buy our vaccine. Okay, but other third world countries for example, in Africa, the vaccination rate is only less than 10% of the population. So you can imagine, because it's not because of the um, um, uh, their people are anti-vaccine, but the government itself doesn't have enough money to buy all those vaccine. Okay, so in 1997, when this thing happened, so investors try to take out their money, their shares. They want to sell back their shares to the company. So imagine at that time, the bank have problems, the economy has problems, so the company also have problems. So if we let these investors, okay, I mean, it is their right, true, okay, to take out their money from the company. But if they um, go about to do about this thing, what will happen to the company? The company will collapse. If the when the company is collapse, what happened to the workers? They are out of job. When they don't have job, what will happen? The NPL will increase. What will happen? There will be anarchy. They will maybe the social there will be social unrest. Okay, they need money to buy food. So if they don't have money, what will they do? Drastic thing that they will do is that they will go and rob someone. Again, when they steal something, it's not because of just a kick or Saturday kick night, just having fun, but actually it's just they just want to survive. So you can see there's a systemic effect. There's a dominoes effect. Okay, one thing happened, will lead to another thing. So in a way, the Malaysian government at that time, we can see this, we can forecast it. We have already identified this risk. So what did this Malaysian government did is that they imposed a 12-month transaction restriction on stock market. That means in 12 months, you are not allowed to sell back your stocks. Okay, so people are shouting, investors are shouting because of they want their money back, but the government said no. Okay, um, you cannot sell back your um, stocks. Okay, if you want to buy, it's okay, no problem. That means if you want to buy, you buy company stock. That means the company will get your money, and then they can use your money to continue their business, to expand, to pay their salary, their worker salaries, and so on and so forth. But if you want to sell back, that means you are asking back your money from the company. It's not allowed for 12 months, guys. For 12 months. So people are shouting. People are saying that. I still remember. I already worked at that time. I still remember people are saying that Tun Mahathir is Maha Zalim. Is a bad person. Okay, Maha Firaun. Because of they don't allow, the government didn't allow. So what happened is that um, people lose trust. But then we just close our eyes, shut our mouth. We don't hear anything. Okay, you plug our ears. So after 12 months, what happens? Something miracles happens. Okay, and in fact, that's when we have this 12-month restriction in terms of transaction. The first one who condemn us is the IMF. Okay, the International Monetary Fund, the World Bank, and they said that is against the right, investors' right. So they claim that Malaysian government is led by a dictator. Okay, Tun Mahathir was a dictator because of it's his idea to have this kind of thing. For me, I think that's it's just only a propaganda. Okay, they're saying that because of they want Malaysian government to collapse. They want Malaysian government to borrow money from them. Once they borrow money from them, that means that we have some obligation with the World Bank, and if anything happen, okay, they can manipulate Malaysian government. Okay, at that time. Okay, luckily we have a good think tank at that time. So what happened is that uh, when the but after the 12th month, something very miracle is happening. You know, all the prices in the stock exchange, okay, double when this restriction been lifted off. The price of the stocks double. So that means you are making more money compared to previously. Okay. So there was a time when all these investors were saying that, oh, the government did a good job, you know, human, right? Always complain, always they are not they are not satisfied with everyone, you know, whatever people do. So that time they said that, oh, the government is very good, very lucky to have this, you know, because of it make them more richer. Okay, so that is something which is quite interesting. Okay, happens when we list out that 12-month restriction in terms of transaction. So that is another way. Basically, we are trying to curb the exposure. Okay, property. It will be under liability loss exposure, okay, intangible property loss exposure. So these are failure to comply with government is basically another topic. So this is so what we need to understand that whenever what we do, okay, in terms of business or in terms of even in your study also, you need to identify the risk. What is the risk of studying? Okay, fail, for example. So how are you going to rectify this? Study. So how are you going to make it better? You have to study hard, you know, for example. So you have to identify the risk, and these are the few things that you need to have in mind. Okay, what will be the loss exposure that you will encounter. Okay, so in terms of business, it might be your property. You have to sell your property. Okay, you have to lay off a little bit, little by little. Maybe the workers also, the business income might not be the one that you expect. Okay, but instead of income, you're losing your money. So those are the things that we need to identify the risk first. Okay. All right. Is 1 hour already? We can take a break. Say 5 minutes. Take a break, everybody. And those who still wants to have 37. Is there anyone wanted to? Yeah, so kita break. We break for 5 minutes. Yeah. Okay, we continue. So far, is there any question that you want to ask? Ada apa-apa soalan? Okay.
Ada.
All right. So, identifying loss exposures. Okay, risk managers basically have several sources of information. To identify loss exposure, first is we do the risk analysis questionnaires and checklists. So it is normally done when it comes to industry. A good example is in oil and gas industry where they must have risk analysis. They will start questioning people, okay, get some ideas, and they can form a checklist, so that they will not missing any information, important information, okay. And then we have this what we call as is physical inspection, and in finance we have this. Okay, this is what we call as auditing. Okay, we will send someone to do the audit, to do audit, to make sure that everything is in place, so that the what do you call it, uh, you have to follow certain procedures, certain regulation laws. So they have this what we call as auditing, and then we need to have a flow chart when it comes to, so that by having a flow chart, okay, technically if you follow the flow chart, the exposure of risk will be minimized. Okay? So in finance also the same thing. Banks, for example, if you want to, you know, fund, or you want to provide loan, for example, there are certain procedures, certain flow charts that you need to go through with. Okay. Now, previously they have their flow chart, but of lately we have another thing that you need to be included in the flow chart, which is the Money Laundering Act. It's just want to make sure that the money, money laundering is not there. Okay. Right now, there's a lot of ways and means for people to do this kind of activities, to financing terrorism, for example. So the least that we're going to do is that we're going to check, even okay, one thing you get to understand this, when it comes to um this terrorism, right? Even in in academic world, okay, if you want, especially for those going to do some research on uh, from research on certain item, which is normally would be imposed to the engineering student. Okay, your proposal, it will be sent to this one website, if I'm not mistaken, one bodies, I can say it's bodies, where they will look at your proposal and see is there any tendency for you to produce, to become a terrorist, or producing weapons, or bombs for the terrorists, that kind of thing. So they have this, you need to get a clearance, especially in Malaysia. So far in UTM, I don't think that we have that thing. Okay, that's the reason why we can see a lot of people are coming to Asia, okay, to do their PhD. But in Europe, for example, when I did my PhD in UK, we need to have have to fill up a declaration form. Okay, ethical review. They call it ethical review, where there's a committee will look into all this, all the proposal, the PhD proposal or master's proposal, research proposal, to identify is there any tendency for you to produce something, okay, produce something that can harm other people. So you see how bad they are right now, because of their fear for their own shadows. But we cannot deny this, and because some people they do this. So like myself, so far, um our ethical review is not as bad as engineering. But if you are talking about social science, talking about psychology, maybe, the ethical form is going to be a bit strict, because of the nature research that you're going to do. I still remember there's one of my colleague. happens to be a Malaysian. Okay, he's a retired custom officer. Retired custom officer. He worked in this in our university, and then he's at the same time he's furthering his PhD degree. So what he did is basically like myself, my ethical review is only fill up the form and that's it. But for him, he has to go through an interview by the university committee, ethical committee, because of the nature of research that he's going to do. Basically, what he did is is he wants to get to know the mindset of abductor, penculik. Okay, so this abductor basically are all criminals. Okay, and so they going to, you know, once they get someone, they will ask for ransom and everything, you know, that kind of thing. So he will study about this thing, and the best part is that all these abductors, their samples are at large. It's not the one that been that you can visit in prison. They are basically at large, and this um criminal is actually all of them are from Malaysian. They are all Malaysian. Okay, there are, if I'm not mistaken, there are 4 Chinese and 1 Indian. This 5 person is wanted by the police, and he showed us the paper cutting, okay, from Malaysian newspapers saying that the police are looking for these people, and yet this guy managed to meet all these criminal, conduct an interview. Okay, they conduct in the safe house. So it's very interesting, and but because of that, he has to go for this ethical review, interviewed by the ethical review committee of of our university. So it took him about 3 hours, you know, to explain how he wants to do the what call it the interview, because of its the risk is that, you know, anything can happen to him, and even though he's a custom officer, I think, and he is very good with his work before. He's one of the, I can say, spy. The one that you know, try to get all the information. So I think he knows what he's doing. He did tell me that time, but I can remember it was like he told me that, okay, first we're gonna meet this, and then we're gonna move here from here to here, you know, until we met at safe house. That's where we're going to do the interview and things like that. So they everything must have a flow chart. So if anything happen, then you might expose yourself to a certain degree of risk. Okay, same goes to bank, you know, in terms of giving loans. Okay, they have certain flow chart, sorry, certain steps that you need to, the bank officer need to identify, sorry, not to identify, but go through all this process, in order to minimize the cost of um, people not paying back their loans. Okay, and then we can also identify from the financial statement, which I think that most of you have taken financial management courses. We did the financial analysis, remember the ratio analysis. So this is basically another method. That's why they sometimes when you do this financial ratio, they call it as the forensic accounting. So basically you're trying to identify, you try to read between the lines, you're trying to identify what happens to the company before it getting worse, you know. So but the one that we teach in our class previously is basically the idea of you want to invest in that company, so you want to know about that company, and that is also another method, to minimize your risk of losing your money. So you will do the financial ratios, and you can understand what is happening with the company, and you decide, you yourself will decide whether you want to invest or not. So basically we are all risk averse investors, okay, type of person. So we do this, but on the other side, so in the other hand, a company also, they use this to identify what is happening with the company, how they can minimize, and they can reduce, you know, they can rectify problem before it become worse. Okay, so you use the financial statement as a source of source of references, source of information. What happened is that that's the reason why they have this, they impose the Sarbanes-Oxley Act, Sarbanes-Oxley Act under GAAP, General Acceptance Accounting Procedures. Sarbanes-Oxley. These are two senators in U.S. Constitution. Okay, they pass a law. That's why they call it Sarbanes-Oxley Act. I think it's 2001, if I'm not mistaken. The reason is that there's come into the place is that um what happened with Enron. Yeah, just now I told you Enron, okay, they create their own SPV because Enron, when they come up with their financial statement, they did some adjustment. Okay, um, the audit firm also worked together with them, so they put a wrong information. Okay, even though the company is losing money, but in the financial statement they show that they are making a lot of money. So because of that, public start to buy their stocks. Okay, buy their stocks. But at the end of the day, the company cannot survive, and all those investors they lose their money. Okay, I think they lost about trillion, if I'm not mistaken. It's a utility company, Enron. Maybe you can check after this. So Sarbanes-Oxley Act states that there should be another, not the audit firm, not the accounting firm, but another parties or another committee outside of this is the one who do the auditing as well. Okay, just to making sure that this is what they call, last time they call it as, I can't remember, there's a term for this. It's like sorry, I can't remember the terms. There are specific terms in finance, when it comes to this, where imagine you are the let's say you are the company, okay, and then certain people from the financial FSA, Financial Services Authority. Those, like for example, in Malaysia we have Ministry of Finance, people from Security Commission. Okay, so you know that this guy is basically looking, they will do the auditing, everything. So what you will do is that company, what they will normally do, that they try to meet this guy, try to be friend, lobby this guy, take them to treat them to dinner and things like that, just to try to make friends. So if anything happen, this guy can basically cover the wrongdoings of that company. So there's a term, okay, in finance. I totally forgot about it. So this is what we were really scared of. And when you become the regulators, this is something which is very very important, very crucial. Okay, even last time when I was with the Security Commission, okay, right after when I quit my job, okay, I quit my job. One of the uh, things that they impose to us, okay, things that I need to do is that we cannot do is that I cannot be employed by any banks in 6 months. Within 6 months after I quit my job, because of that time, most probably, when we from the Security Commission or from the central bank, all these other banks as well as companies, they're eyeing for you, because basically they know the regulation, the law. So whenever they want to do something, if you're working with them, it's much more easier for them. So basically they will, eyeing for you guys. So after 6 months, we are not allowed to work with any banks or any company. So you have to, it's like a moment where you just sit around doing nothing. Okay, and then after that, then only you can, unless you want to go for another type of profession, okay, then it's okay. But as far as business and banking is concerned, you are not allowed to. If you've been caught, then there'll be a fine. And also the worst part is that you won't get any job in Malaysia for the rest of your life. That's the bottom line. Those who are working with all these regulators, that the bottom line. It sounds so bad, but then that's how it's gonna be. Okay. And then we have this historical data, lost data if you have, but historical data. Now that's why we have CTOS. we can check whether previously you are a defaulter or not. Okay. So we have this kind of data. We are going to use this data. Whatever regulation previously, we have to look into it, in order for us to identify what kind of risk that we are going to venture in. Okay. And then the industry trend and market changes can create new loss exposure. Okay, I think I explained this thoroughly already. Okay, industry trend, the market, okay, trend right now. Okay, what is the trend right now? A lot of people are buying online, right? Okay, buying online. Okay, one question that I want to ask you guys: if you go to any shopping mall, okay, like for example, Parkson or no, this Mydin or Tesco, are they going to provide plastic bag anymore or not? No, right? They said that is harm to the environment, blah blah blah. Okay. But then because of that, a lot of people, and then because of the MCO, a lot of people are using online. But do you ever thought or not? Have you ever thought about the plastic bag, the cover that the packages that you receive, all those plastic bag is actually make it worse to the environment. Okay, there's a lot of plastic bags when it comes to when we have this online purchasing. The reality is that, we should not have this plastic bag, should not have any plastic bag, is a plastic bag free. In Malacca, for example, there's no more plastic bag. But then when you buy, imagine how much plastic bag right now, okay, as we speak, been dumped into the dustbin. So it's quite a lot, it's quite a lot. So it's a risk to the environment as well. But then, people didn't say this. Okay, it's much more because it's safe. Don't you have to go to the mall, meet people, expose yourself. So you just stay at home and all this thing comes. But the plastic bag, we're talking about the plastic bag, that harms the environment. So that is something we have to think about it. So next time, if you want to buy, maybe, you know you have to think about this. Okay. All right. So financial risk management framework. Okay, we're going to discuss a little bit on the financial risk management, the framework. Okay, so basically there are 5 steps. Okay, so when it comes to identifying the risk, okay, we have 5 steps when it comes to the framework. Okay, the first step is towards a better financial risk management. First is the automated monitoring. Okay, that's why um, in a way we want to overcome this. Okay, ideas to overcome the risk that you have already identified is by implementing automated monitoring. So automating machines and everything, technology, should be the topmost priority for business because they can identify. Okay, there will be no human error. I mean, human, we have errors. Okay, so using this kind of technology, um, is much more better in terms of identifying. So, for example, the stakeholder is automatically notified if any risk goes above a designated level, ensuring that all risks are mitigated and managed as quickly and efficiently as possible. So it's like an alarm. If something happened, they can identify before it become worse. Okay? If you watch this Deepwater Horizon movie, okay, there are a lot of indicators. They are using machine, to let people know that something is not right, so that you can stop, you can rectify, you can identify, and then you can assess the risk, and then and so on and so forth, whether you want to take action on it or whatever. So using this automated monitor, now it's become reality. Okay, we have artificial intelligence, AI, where, for example, there's a one system, they call it as it was produced by Intel. Okay, I forgot about this thing. Uh, Vision something, vision system, vision or something. I can't remember the full name. It's something to do vision, meaning that the machine will, yes, the machine will identify. Let's say, for example, you are in a factory, right? Okay, and you have this very big machine, production machine, right? As a human, you don't know what is happening inside that thing. What thing needs to be changed? What things in that big machine needs to service? But using this AI, this vision system, if I'm not mistaken, okay, they can identify that, oh, this belt need to replace. You need to change this nuts because of it's already wear off. So they use a computer, they use machine robot to identify this kind of risk, which as a human being you are not able to identify this. And when it comes to QC, for example, okay, you can imagine you are in the factories and you're the quality control, and basically you're producing, let's say you're producing a remote control, aircon remote control. So if you just look at it, you cannot say, it's very difficult for you to say that this is not the what call it, the size, you know the thing is exactly what you want it to be. By using a machine, a robot, AI, they can identify if there is a slight um, uh, thing that not according to the spec. Okay, they can identify. So we use this even in banking also. We have also the same thing. Okay, imagine I don't know whether I don't know whether you have a credit card for some okay, I take it I this credit card as an example. What happened is that if let's say you have a credit card, and you use your credit card around your area, and then all of a sudden, for example, you're using your credit card mostly in Johor, for example, and then all of a sudden there's a one transaction happens in Klang or in Kelantan or maybe in Thailand. Okay, so there is a system in the banking in banks that can identify there's a abnormal transaction. Okay, so when they have this abnormal transaction, because all this while they have the data, okay, they have the data that you are basically using this credit card around Johor area, or but all of a sudden one transaction happens in Thailand, for example, using the same card. So what happened is that this system will notify the bank saying that something is wrong because the trend doesn't look nice. So what they will do is that they will block your credit card automatically, before it become worse. That means they suspect that someone might have cloned your credit cards, used in somewhere else. So what happened is that the bank will call you. Okay, they will notify you. They will ask you, did you ever have you used your credit card in Thailand? So if no, that means your card been cloned, and what they will do is that they will block all your credit card under your name, under your identification numbers, using your identification numbers, maybe using your social security numbers. They will block everything. Okay, before, because they don't want you to incur more loss. Okay, so this is what they call as automated monitoring system, okay, that we have right now. Okay, increase stakeholders involvement in risk discovery, risk assessment of. This is where you will um you will involve these people with the risk assessment. Okay, so that they can also identify. Risk assessment are often done without the inclusion of all stakeholders. This normally is between one department. This department is the one that identify all the, whereby the one who are working is the one that should know about all these things. Okay, so that means they can only knows about this top level risk, management risk, whereby on the ground itself they don't identify. So it's much more better. Okay, right now the framework says that it's much more better if we include these people, ground force, workers, the ground level workers involved in the risk assessment. Okay, they are the frontliners. We can consider they are the front line. Okay, they are the one who doing it. So they should know about the risk. They should be involved with this risk assessment, risk management exercise, so that they can also identify. They can give some ideas, because top management, I mean, yes, of course, they can see the company overall. Okay, from the helicopter view, they know what's going on, but the reality is the one that are doing it. Okay, so it's right now it's much more better to involve these people when it comes to the risk management. And then number third is to prioritize risk. Okay, you need to categorize according to the severity of the risk of the threat. So that you have these ideas which one needs to be prioritized. Okay, there are um, what call it types of risk. Types of risk, whether it's severe, not severe, very minimum, that kind of thing. So we need to identify this. Okay, you have to prioritize the risk. Like for example, if you invest in stocks, okay, you have to prioritize. You have to understand. Okay, if I put 100,000 in this company, what will happen? If I put 50,000 in company A, 50,000 in company B, what will happen? So basically, what you're doing is you are trying to perform. You are going to develop what we call as portfolio. Okay, portfolio investment portfolio. So basically, you're trying to diversify your investment. Try to mitigate your shift to another type of investment. There's a say is that do not put all your egg in one basket. Okay, so it's about diversification, meaning you put certain amount of money, percentage in company A, buying investment in company A, company B, C, D, E, and maybe some other types of different financial product in different country, in the different states. So you try to diversify that thing. Okay, so you need to categorize all these things. If this thing happen, what will happen to my money, my investment, that kind of thing. You have to prioritize the thing. Make risk visible. Okay, tell everybody this is, as a bankers, they should have to do this. Okay, they have to tell all the customers what are you going to face if you buy this, what you're going to expect, that kind of thing. So basically that is an obligatory under central bank. Basically central bank, they only have two main priorities things that they have to do to the public. One is fiduciary rule. Okay, fiduciary rule means that they want to make sure that all the money in the bank are safe. You can withdraw at any time, you can deposit your money anytime, and then they will safeguard your money. Okay, they don't take your money, they only safeguard. They just look after. They never ever in our life, or people go to the bank and tell the tellers that I don't want this money anymore, please take. No, we just put deposit our money, ask them to keep for us. Okay, because we're not going to bring our money, um going around with ton of cash. Okay, so that's why we put our money in the bank, and bank should look after it. So that what we call as fiduciary role. Another one is the conduct of business. So this is the two main things that the central banks are looking into. Okay, the conduct of business is basically they will, anyone who wants to sell financial product must, okay, is obligatory to explain the risk, explain the product itself, because not many people understand financial product. If you're talking about derivative, for example, if you're talking about warrant, for example, layman like us, okay, normal people like us, we don't know about that thing. Okay, so the bank or the financial product provider should educate us, should tell us, okay, that if you buy this, this will happen, then only you decide. Okay, but that was not the case. Some people, the officer also, there's a lot of issues. Okay, some officers, they just simply disclose this certain information only. They can only tell you few all the good things only. The bad things they didn't say. Okay, that's one scenario. Another scenario is that the officer itself doesn't know about the product. So how can he explain to us? Okay, it's like third is that the investor itself. We have this what we call as herd instinct, herding. gembala, herd instinct. We just follow people. So if your friends buy this stock, you just simply buy that stock without checking, without, you just simply buy because of your following your friends. And this is what happened. This is normally what happened in financial world. Even bank also the same thing. One bank produce a credit card, no interest credit card, another bank will follow because there will be a lot of customer will go to that bank, so they also want to have a piece of cake, so they also produce offer a credit card without interest or loan without interest. And these are very, very scary, and it's very dangerous because of everybody just follow everybody. Okay, so this is what happened to the big five. If you watch movie Big Five, talking they're basically talking about mortgage bond crisis in 2008, if I'm not mistaken. Yes, 2008 mortgage bond crisis. They just follow people. Okay, so at the end of the day, the housing price, there's a bubble, a financial bubble, and then that financial bubble burst. What happened is that they lost about trillion in terms of investment, and so in 2008 US economy hit by a very bad recession. Okay, the financial bubble burst. Okay, and then the last one is enable risk ownership. Okay, risk ownership has proven to be the most effective risk management. Be part of the people who is responsible in any decision making. Just like that, you have to be involved with this. We have to be involved in this. Okay, so okay, the next one is will be the analyze the risk. So it's already one and I think we can stop our class today. We will continue with analyze the risk next class. Okay, before that, you have any question, guys? No. All right, okay. So if that the case, and our next class when is our next class?
Sunday, Doctor.
Sunday. Oh, okay. I think the Sunday class, the 1 hour class,
Sunday.
I think we can move the class to Tuesday today. We can have like 3 straight hours, right? Rather than we have 1 hour on Sunday. Okay, so it's much more easier. Then we can, if let's say we have a test, it's much more easier for us to do this. So we block this 3 hours for today. So we will start next week. All right, we will start next week to have 3 hours straight. Okay, so I'll meet you on Tuesday, next week. Okay, guys. All right. So thank you very much. All right. See you.
Thank you, Doctor.
Bye.
Thank you, Doctor.
Thank you, Doctor.
Thank you, sir.
Bye.
Thank you, doctor.